Hi everyone, in this video I'm going to answer the question that I know many of you have, and that is Verizon Communications stock dividend yield of over 6% safe? Is it safe? Can I rely on it for several quarters and several years into the future? And so let's answer that question right now. Looking at Verizon's dividend yield here, you can see it's rose up to 6.6%, and it's arguably, well, not the highest it's been since going back to 2018, but close to the highest that it's been in the last 5 years. So one of the things I like to look at when I'm determining if a dividend yield is safe is revenue growth. I want to see revenue at least being stable, if not rising slightly. And with Verizon, looking back over the last 10 years, I can see revenue is increasing solidly, going up to 133 billion, and that's up considerably just over the last few years and over the last 10 years as well. So this is a check mark telling me, okay, revenue is stable, it's increasing. That's good news for the dividend. Okay. So one of the other things I like to look at in the determining if the dividend is sustainable is the free cash flow per share. And looking at Verizon's free cash flow per share of $2.59 in its most recent quarter, this is up from its previous quarter. However, it's been on a downtrend over the last 10 years. Used to be over $5 per share. Now it's down to $2.59 per share. Of course, Verizon has invested aggressively in rolling out its 5G network, and that could be impacting its cash flows over this near term, but that capital investment is mostly behind it. It's began rolling out this technology, and it should start reaping the benefits of those investments over the next few years. And so not so much of a negative here in the free cash flow per share, even though it's been lower over the next few years. But inherently, Verizon stock, that's one of the main risks. If you've looked at some of my other videos on my channel, when I cover Verizon stock, I highlight that as one of the risks is that it's going to need to invest in these new technologies every cycle. Used to be 4G, 3G, and now 5G, and we don't know what the next one is going to be, but it's going to need to invest in that if it's going to want to be one of the dominant providers of internet, one of the dominant providers of mobile communication devices as it is now, along with AT&T and T-Mobile. And so if it wants to stay up there, it needs to keep investing, and that is a risk because at one of these cycles, it may make those massive investments, but then the cash flows don't follow afterwards. The cash flows don't follow, and for up till now, the cash flows have followed the investment, but there is the risk that they may not. Right? So the next metric I look at is earnings per share. And of course, earnings per share, I look at this because it's like a household. When you're spending money in your household budget, you cannot spend more than you earn. If you do, you're going to be spending down whatever savings you have piled up. And when you go through your savings, if you keep spending more than your income, you're going to need to borrow to support that spending. And eventually, you're going to max out your credit cards, and you cannot keep spending at that level anymore. And you're going to have to pull back spending. And in this case here, the spending would be the dividend. If Verizon keeps paying its dividend above its earnings per share, eventually it will run out of savings and run out of the amount of money it can borrow, and then it will need to reduce its dividend. And so if I don't see solid earnings per share, that's evidence to me that maybe this dividend is not safe longer term. But for Verizon, I'm not seeing that. If we look back at the last 10 years, in its most recent year, the earnings per share of $5.32 was much higher than the earnings per share going back to 2014 and before. So nice and steady increases in earnings per share. That's good news for Verizon dividend investors, for those of you looking to get some passive income from Verizon's healthy dividend yield. And the final and perhaps most important metric I look at when determining how safe is a company's dividend yield is the payout ratio. This measures the percentage of its earnings per share that the company pays out in dividends. And for Verizon, it's paying just 55% of its earnings out in dividends. That means there is a 45% buffer in case its earnings per share decrease temporarily, moderately. Then Verizon could continue supporting its dividend payment even with a moderate decline in earnings per share. So, all in all, putting this all together to answer the question if Verizon stock dividend is safe, I would say it is relatively safe compared to the universe of dividend stocks that I follow. Verizon's metrics are relatively healthy to support a continued healthy dividend payment. Now, those might change over the next few quarters and over the next few years. So you're going to want to subscribe to my channel to get those updates. Verizon, AT&T, and T-Mobile are three of the many stocks that I cover. So you'll get those updates as soon as I know about them. I'll quickly make a video about them and you'll be informed. So if you're interested in Verizon as a dividend income stock to support some passive income in retirement or to help build wealth during your income earning years, Verizon stock's dividend looks relatively healthy. All right, so there you have it. If you've gained any value from this video, please go ahead and hit the like and subscribe button. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/Parkev to get your 10 stock picks now.